Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. We actually have so much to talk about this week that I don't think we're going to have time in Bondcast, or it's just going to be an extra long episode. So I hope our listeners even are ready for that. I'm going to start with the Fed because it's been a really volatile week kind of across the board in fixed income, but it was really all kickstarted by the higher than expected US inflation print last week. That came on Thursday, so it was just after we caught up last week on Bondcast, and it feels like a whole lifetime has happened in rates markets since we last caught up. So let's start there. We had higher than expected inflation print on Friday. We then had a kind of Wall Street Journal article during the Fed's blackout period, guiding markets towards a 75 basis point hike ahead of the Fed meeting yesterday. We're recording this on Thursday. So Jan, what did the Fed actually deliver at its meeting yesterday?
So there's a ton to discuss there, but to quickly recap on what they actually did, we got a jumbo hike, 75 basis points, the first one since 1994. Like you said, the Fed had almost pre-committed to doing 50 basis points in June and July, but I suppose the inflation number, which was pretty bad, no matter how you look at it, there's just really not that many silver linings within the report. It must have spooked them in a way that they kind of like the Wall Street Journal had an article saying that the Fed is considering 75 basis points, which no matter what, it was during the blackout period. There's really no kind of like, maybe it was a roundabout way, but nevertheless, that's what they did. We got the 75 basis point hike. The guidance forward was that this is not going to be a common occurrence. So July could be 50 or 75. We stick to, given our high inflation forecast for next month too, we think 75 is another likely delivery. Again, very important to point out, I think, that the communication channel was really, really muddled because the whole sending that 75 basis point message during the blackout period, adding a lot of volatility on top of volatile markets, kind of like drives out a lot of participants or like liquidity providers in general, and then tightening financial conditions pretty abruptly, and then going to the meeting and saying this is not something we might, this might be a one-off thing. I thought that was very, not the right way to address things. A little counterproductive. Nevertheless, there was one dissent. Esther George, she pretty much was, not in line with the 75, wanted a 50 basis point hike. Surprising because she has historically been one of the more the hawkish members of the FOMC. In addition to that, this was a quarterly meeting, so we got all these economic forecasts, the updated what's called like the dot plot with the median rates forecast from the committee. And that was also pretty high. Like this year, the expected median interest rate expected median Fed fund rate was 3.4%, going up to 3.88 next year, and then indicating cuts the year after that back to 3.4. So what that implies is 75 in July, and then you have another perhaps like 15 September, and then 25 for the rest of the year, or alternatively, a couple more 50s. And that's pretty much it. The economic forecasts were tweaked a little bit to show higher inflation for this year, lower growth, as you would expect. Unemployment rate starts edging up, but no, they're pretty aspirational, I'm going to say, not really, it is a little bit of a disconnect with the amount of tightening they want to deliver versus the smooth kind of like the liftoff in unemployment, and just still indicating a very softish landing, which seems less and less likely now.
The market reaction, I suppose, was a bit mixed, maybe a combination of this idea that, they thought they were going to do 75 in June and in July, and perhaps those expectations were tempered a little bit, perhaps around this idea that they could slow pretty quickly once they got to neutral rates. What do you make of how the markets moved kind of immediately after and then in the today's session following the Fed?
I mean, listen, we've been talking about how the forward channels are what really prices the financial tightening. It's less so what happens today in the overnight Fed funds market, more so what the Fed intends to do and if they can follow through. And just the whole, signaling a super tight policy decision and then saying that it might be a one-off. I think it possibly chipped away from the credibility of the forward guidance. It shows how volatile the environment is compared to and reactive to the incoming data. So we think that they're going to get to 3.4% now with this. We're pretty much in line with the dot plot this year. We have 75 for July as well, and then followed by 50 in September and 25 for the other two meetings in November and December. So it's a very significant pace of tightening, which still comes in the face of data that is looking less and less strong. So it's going to be interesting times ahead, but interestingly, real rates keep going up, and particularly today we have like an interesting bear steepening of the curve while equities are selling off. So there is some disconnect there, and we still think that rates will eventually, 10-year yields and such will end the year lower, but it's hard to fight the trend, and our confidence for the, let's just say, 3-day outlook is significantly smaller and compared to the 3-month outlook. We see kind of a little bit of normalization, but right now it's just hard to go with a straight face and say, yeah, you should buy this when yields rip by 20 basis points in a day without any news or data.
You're preaching to the choir on that one. I guess that was really going to be my final question. So you've already kind of answered it in part, but perhaps just to put some more numbers around that, what are you thinking in terms of what might be your year-end target for 10-year Treasury yields? Let's say you were bullish at much lower yield levels than here, and in the past couple of days, it hasn't just been a front-end move. We've seen huge moves across the curves in global fixed income, and as we speak today, although in these markets it can all change very quickly, but as we speak, it's treasuries that are kind of bucking the trend of the rest of global fixed income and are bear steepening, as you say. So longer end yields are rising faster than front end yields, and we're probably close to 350 now by the time we get back to the desk. So where do you really think that could settle over the longer term, leaving aside the kind of 3-day or weekly volatility at the moment?
Yeah, I think so. We have our year-end forecast at 3% for 10-year yields. And really, I think that should come from real yields falling as opposed to inflation expectations, which more or less, forward inflation expectations, by the way, are extremely anchored, if anything. I mean, you have 1 year close to like 2 3/4, which is hardly runaway inflation. 10-year break-evens, again, they'll probably be very different by the time this is released, but now they're close to like 2.7% too. So I'm not too worried about the inflation component. Don't really have a strong view that can go much higher given the significant pace of tightening. But I think real yields for 10 years sticking around over close to 70 basis points. I don't think that's right, especially when people's focus shifts back to data and the longer part of the curve which contain more information about the whole boom and bust cycle. The more the Fed doubles down, it's hard to see how we're not going to have a harder landing or something might break down the future. It's of course impossible to forecast what exactly when will break, but it just feels like it's going towards that direction. So I would expect them to come back to, call it like 25 basis point, 0 to 25 range, which brings the 10-year yield to 3%. So that's kind of where we see. I think growth worries will resurface, but it's just they've been really out-trumped by like the Fed's kind of 1-2 punch.
Very nice way of putting it. All right, I appreciate that was a very whistle-stop tour for what has been an extremely busy week in Treasuries, but in the interest of keeping this brief, and given that we have so much else to cover, because it wasn't just the Fed and Treasuries that were moving markets this week, we also woke up on Tuesday to the news. Was it Tuesday or Wednesday? I'm losing all track of days here. I think Wednesday, actually. I'm getting ahead of myself. On Wednesday, to the news that the ECB would be holding an ad hoc meeting with a view to kind of discussing fragmentation risks in the euro area after, peripheral spreads, but BTP bund spreads in particular widened significantly after the meeting last week. Remember, we discussed on this podcast that it was kind of disappointing that they didn't really give us any detail on how they might tackle, fragmentation in sovereign spreads. The market also felt it was very disappointing. So they had an ad hoc meeting, and the last time I remember them doing an ad hoc meeting was back in March 2020. So very reminiscent of bad times and painful markets. But here we are. So Giles, what did the ECB announce from this week's meeting in a nutshell?
Right. Okay. I mean, you've given the background very nicely there. I mean, it is important just to stress we saw 10-year BTPs sell off by 70 basis points, and in fact a little bit more than that, between Thursday last week when the ECB had its meeting and this meeting midweek to talk about financial fragmentation. Now that is just a phenomenal move, and naturally that brought in lots of concerns about the level of spread and the outright level of yield. And there was lots of interest, for example, about whether Italy's debt is still sustainable at these sorts of levels. And I hear lots of people saying it's not, but that's never been our view. But we have been of the view that there would be stress in the interim as the market adjusts to this new world. And so to answer your question directly, what did the ECB announce? Well, it took its time. We were all sitting in front of our screens frantically F5ing, hoping that it might be a little bit sooner. When it came out, we kind of wished that it might have been a little bit punchier. But essentially what they said, it seems, was that they finally will use their flexibility that in the reinvestments of the QE programs that they already have in order to try to support spreads a little bit, Italy in particular, not named. And so the assumption there is that has become more aggressive, although it is, I should stress, difficult to infer from the markets at the moment. And they also, and this is the important point, they promised that they were going to accelerate the investigation. So they have these task forces, so technical task forces, legal task forces, to design a program to deal with the problem of fragmentation in financial conditions as they start to raise rates. And now, I mean, I think that this makes sense. I mean, it makes so much sense that the most confusing aspect of it all is that, given it was so obvious that this was a good idea, why didn't they actually announce that they were doing this and set these people to work last week, rather than waiting for all this market turmoil to force them to do it just a week later in a hurry, right? So I think questions legitimately can be asked about that. I think the way there's a lot of commentary out there, a lot of I mean, some of it more sensible, some of it reasonably feverish about what they might actually announce, and it's something that we are formulating our own response to as we speak. But I think the main elements are that they will most likely announce this in July. I think that depending on how the work progresses, it's possible they may trail some of it in speeches / blogs, whatever, to try to calm markets in the transition. Well, I mean, maybe this is for a later podcast, to be honest with you. But the way that we're thinking about it at the moment is that conditionality will be involved, but most likely, but it will be light, possibly linked, possibly to the NGEU recovery fund conditionality, possibly coupled up with some kind of debt sustainability analysis, most likely to be generated by the Commission. There are questions about whether it might be sterilized. So, might it just be a strengthened version of this using flexibility. So instead of just saying, let's use redemptions over 1 year, let's extend that period a little bit. So maybe we can even consider rolling out of bonds a little bit before redemption, further before redemption, or maybe just anticipate redemptions in 2 or 3 years' time and use those proceeds. So that would be one possibility, I think. Another might be just an outright tool, but in parallel to the existing ones. And I think that this will just become part of the monetary policy mix. And meeting to meeting, they are likely to announce what their stance is around this. Don't get too excited. They're not going to tell us what level they're going to defend in BTPs or anything like that.
Are they?
But I think, but no, I don't think they will. Strangely enough, no, you don't want to give. That's just too much of a red rag. Tell the market something like that, and it's just an invitation to come and test me, right? Now that's the last thing they want. And ambiguity is useful here, but of course, in the committee, that's a kind of discussion they will, I think, have to have, and I think that will have to be part of the discussion each 6 weeks. And the reason is that the definition of what constitutes financial fragmentation, I think, varies, right? I mean, the more, if you have a 200 basis point widening on a 50 basis point rate hike, that's probably that's probably a sort of market dynamic. You've probably got you've got a liquidity effect rather than a solvency effect there, very clearly, right? 200 basis points on a 200 basis point rate rise, maybe that's not. Right, so I think that's something they have to figure out how they're going to evaluate on an ongoing basis. So a long answer to your question there, Imogen. Apologies.
Very long. I hope Visco is listening to what you're saying then about these spread levels.
Oh, he definitely will be.
I'm sure. So I guess I've got 2 questions off the back of that. Perhaps first of all, we can just quickly go back to the first tool that we probably know more about, this idea that they can use reinvestments flexibly. How powerful can those reinvestments be, do you think, in the kind of near term? That was one half of the toolbox that they announced yesterday, is that they will immediately start using reinvestments, as they can. So how powerful really are those reinvestments, do you think?
In principle, they're more than sufficient to bridge quite a long way between what we have now and perhaps a new equilibrium or a new or some new anti-fragmentation tool that can restore confidence over the longer term. They're significant, right? I mean, I think that in the PSPP, that just as a reminder to people, there are quantitative easing is split into lots of different programs, and the older sort of more traditional program called the APP has this sovereign component with the PSPP. The amount of Italian bonds that are likely maturing this year in that, which can be anticipated in order to those redemptions can be anticipated. That means you can say, right, I'm expecting to get 10 billion from in 3 months' time, so I'll just do that now, right? That's about 50 billion per year in the case of Italy, we guesstimate. Okay. Then in the the PEP, which is far more flexible. So within that, the ECB can they can use flexibility across jurisdictions and across assets, as they've repeatedly reminded us, which means that they can anticipate the redemptions in principle of ABS and Germany and so on, and buy whatever they want with it, or whatever they need with it. And there's probably about 200 billion. And obviously, if you have firepower potentially to support Italy up to, well, I mean, if it's in the hundreds of billions in the short term, I don't think that anyone really can legitimately question whether that's enough to support the market in the short term.
Okay, well, that was going to be my final question then. Do you think this is enough? Markets rallied significantly yesterday. I think, well, in yields, 10-year BTPs were down about 40 basis points by the end of the day. I think there was a bit of confusion on the announcement, and you alluded to this, when you started speaking on this pod, that actually it felt like it wasn't a particularly kind of juicy announcement, if you like. It lacked details, I would have said, which is perhaps obvious given they've only just started this process. We weren't going to get the full details of a tool that might work because they're just doing the background work. But it felt on first read like an insufficient announcement, but actually markets seem to quite like it. So where do you think we go from here in peripheral spreads?
Well, one of the things that we have noticed from our client conversations in recent weeks is that actually the sense that there's a genuine crisis here, in the sense of a solvency crisis, a political crisis, something that is possibly going to lead to an Italy exit from the euro, for example, or some kind of restructuring in a year or two's time, has been absent. Nobody really believes that. And actually, we have had the sense that there has been a reasonable amount of interest in what was going on as a potential opportunity. So I think that people were primed to a certain extent to look for the positives here, looking for this sort of thing as a trigger. As I've just said, I think that in the short term, the flexibilities are potentially an effective enough bridge to a more permanent solution. And so for the time being, I think it is enough. The risk remains, of course, that the solution that we think is possible is delivered in some way which is too diluted and then doesn't convince. But I doubt that is what we're looking for. So overall, I think that we are, the move has largely happened, to be quite frank, but we are left neutral to maybe a little bit positive, actually.
Okay, and then just before we move away from Europe, perhaps we can just touch on core yields as well, because obviously with everything else that's been going on, they also have been moving a ton. I think we probably, although, like I said earlier, it feels like such a lot has happened in this week. I don't know if we did touch on this in the Bondcast last week, but you revised up your 10-year Bund target to 2%. And with, I think probably when you revised that up last week, you didn't realize that today we'd be about 15 basis points away from that. So how are you feeling about core rates here? Is that 2% with upside risk, or once they get to 2%, do you think, a fair amount of this move is really done now?
I'm trying to figure out I'm trying to remember when it was exactly that I did raise that forecast. It was one of those ones that it required a big note to make a big splash about it, and I kept saying that I would do it, and then things got in the way, and the market moved an inordinate amount in the meantime. And we're now, I think, did you just say 50 basis points? Well, I think we're about 15 basis points. Yes, indeed.
15.
Okay. It's an important clarification. So we are very close to that level already. At these sorts of levels, clearly conviction is lower. And I actually, I don't really know how I'm going to fall after a longer assessment of the risk reward at 2%. I mean, at the moment, I still see higher rates, but modestly. And I think it's 2% starts to feel like a proper correction for what we foresaw earlier this year. So ask me again next week, Imogen.
All right. Well, good
It's
job.
your turn now, I think.
Yes, my turn.
And stop putting me on the spot for hard things like that.
All right. Role reversal. Bank of England. You go.
Well, okay. So it was an interesting meeting. I guess, at least on the analyst side, it seemed like there was a reasonably solid consensus for what we actually got in terms of the 25 basis point rate rise. Markets were going for quite a bit more than that. But then, rather confusingly, we traced an enormous range. I think the intraday low to high was probably in excess of 30 basis points in 10 years, and we're significantly higher on the back of this. So what on earth is going on?
Well, I wish I could really answer that, but let me try. So you're right, as you say, analysts were, I think every sell side analyst that forecast I'd seen expected 25 basis point rise. The market was pricing in about 40%, and it's kind of whipped around a bit over the last couple of days or months even, but about 40% of a 50 basis point rise. So it wasn't really even market's base case, but certainly risks were skewed that way. And certainly after, the Fed kind of ramped up talk of 75, a lot of people were saying that the Bank of England are going to have to do 50. Today. So 25 basis points pretty much in line, but risk skewed to the upside. The vote was 6-3, so 6 members in favor of 25 basis points and 3 dissenters for 50 basis points. That's exactly the same as it was last meeting. I guess that offers a slightly hawkish tilt in that, if you recall, in the May meeting, although the vote was 6-3, there were 2 members, or at least 2 members, that didn't want any guidance on further rate rises being required. So those 2 members have obviously decided in the last 6 weeks, they've gone from not wanting any more rate hikes to an additional rate hike being required. So that's kind of hawkish at the margin. But the real shift, and I think this is where the ambiguity has come in for markets, is around the language around further tightening being required. They've gradually been phasing that out in a dovish manner. Back in, I'm losing track of all my meetings, but prior to the May meeting, they said, most members viewed further tightening as being required. That was diluted in the May meeting to being some members, so not all members, but some, thought that further tightening may be required rather than likely be required. So also, I think, a bit of softening on the probability. And this meeting, they took out that guidance altogether and really replaced it with just a pledge to act forcefully if inflation pressures are more persistent. Now, to me, that reads as dilution, as in a dovish tilt to guidance in the very near term, and perhaps hawkish risks further out if we do start to get, persistent upside surprises to inflation versus the Bank of England's forecast. But the use of the word if, and they say if any further tightening is required, I think really suggests that, in the very near term, they don't see risks of 50 basis points. That's not what their base case is telling us. Over the longer term, if we start to see more persistent inflation, we might need to see a faster pace or a bigger size of hikes, but that's not what they're telling us for the next couple of months. Markets have really placed a lot of weight on this idea that they're going to act forcefully, and particularly obviously following the Fed. And it's not just been the Fed. We've had a flurry of hawkish central banks. We had the SNB this morning surprising markets by hiking 50 basis points. But it really felt like they added in that sentence more in the context of this kind of global hawkish shift that we're seeing, to show that they're not just in the Fed's slipstream. They are doing their own thing. They're reacting to their own inflationary backdrop, which is different to the Fed. The Fed felt like they had to hike 75 basis points because inflation surprised to the upside in Friday's print prior to the meeting. We don't have this month's inflation print for the Bank of England, but we don't think it's likely to surprise to the upside. And as we've said on this podcast before, back in the May meeting, they already kind of revised up their forecast in a fairly significant way. They revised up their inflation forecast for the end of the year. They pushed out the peak when they expect to see that. They revised up their wage inflation forecast. So there's nothing about the data over the last 6 weeks, or even we think over the coming weeks between the next meeting, that should suggest that they would need to go at a faster pace than required. And there's nothing about the language today that kind of changes our base case forecast that they do 25 basis points in August and then pause until next year. Markets disagree, and I think that there is a lot of ambiguity, but it just seems odd to me that if you really felt like a significant degree more tightening was going to be required over the coming meetings, that you would take out the language. Why would you not be more explicit about what would be required instead of actually taking out that sentence about the degree of further tightening that will be required?
Okay, so maybe we can round up with me pressing you for a bottom line about what this means for longer term rates. And we, similarly to everywhere, we've done lots. What's your sense for how much more?
Yeah. To be honest with you, I would echo your thoughts on the European side. I think, over the last couple of weeks in particular, gilts have been driven by global factors. There's not been a lot in kind of on the domestic fundamentals front that would lead you to believe that gilt yields should be where they are, I don't think. The Bank of England is clearly more dovish than everyone else. Data is turning over quicker in the UK than it is in the Euro area, for example, where it's been, more resilient. And it's really, it's essentially been the Fed and Europe led this shift in fixed income, and they've taken gilts with it. So, we had a 2% target back in April. We sort of tentatively revised that up to a vague target somewhere in the region of 220. We've obviously well surpassed that. I think, when I left the desk, we were at 265. And I think probably, I can see a scenario in these volatile markets where we go a little bit above that. But I think at these levels, then my bearish conviction is significantly weakened. And, we have this 10-year fair value model for gilts, and there's a number of different ways you can look at it. But if you look at it from just a domestic factor perspective, including our own forecast for bank rate, which is now just one more additional hike this year, you actually get a fair value for gilts at year end at closer to 2%. If you put in market expectations, that's a little bit higher. I think you get somewhere closer to 230. And then if you try and kind of include a global factor, given, as I said, that it's been global factors that have been driving gilt yields, and I've done that by just sort of replacing bank rate with a rate that includes Fed funds, bank rate, and the refi rate from the ECB, you still only get yields at the end of the year. If you include market expectations for those rates, that is, which by the way is, on the ECB and the Bank of England side is significantly higher than we're expecting, you still only get gilt yields at 260, 265 at year end, which is where we are now. And as I say, we think those kind of front end expectations are much too high. We think that the data is going to start to turn over. We think the Bank of England's going to slow. This idea that they're going to hike an additional 165 basis points by the end of the year is nonsense, if you ask me. And I'm kind of regretting saying that since this is now recorded, and I'm sure Jonathan will play this back to me at the end of the year if they do that. But I think all of that can keep a lid on yields from here. And just as you said, the pace and kind of speed of this correction feels like it's done enough now. And I think 265 is really the limit.
Okay, there you go, listeners. Imogen Bachra calls the top in UK rate.
Famous last word.
But I think I guess we probably that's all we have time for, and I think probably as much as our listeners can possibly consume in one sitting. So thank you very much, everyone. And I am going to very clumsily do the outro now. Just reminding you, if you enjoyed this podcast, please hit like and subscribe so that you can get the new episodes as soon as they're available.
Very good job, Giles.